Many of you have asked me how I'd allocate my own portfolio, so that's what I'm going to show you here step by step. Now don't pay too much attention to the end result, because what I've done may not be appropriate to you. Look at the process, not the final allocation. The other thing is I can't cover everything in 10 minutes. So there's also a booklet to go with this, which you'll find in the description. And if you want even more, then why not join our online community? If you support me on Patreon for $5 a month or more, you get to join our Slack channel and you get to join our calls on Sunday evenings at around 8 p.m. And that way you can join our online community and learn how to invest with friends. So let's find out how to do that allocation in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's look at what's changed since the last time I changed my portfolio. Here's a comparison of how expensive the equity markets are across the globe. This is using the CAPE measure, which is the cyclically adjusted price to earnings ratio, and you can see that the UK is blue, which means that it's fairly cheap, and the US is red, which means that it's expensive. And that was one of the reasons why I chose not to buy US equity in 2017. In 2018, the US was still expensive and the UK was still cheap. And in 2019, the picture is pretty much the same. The reason why I look at the CAPE measure is that because of all the valuation measures, it's the best at predicting long-term stock returns. And by long-term, here we're talking about 10 years ahead. A lot of the measures that people look at actually have no bearing at all on long-term returns. In fact, everything to the right of this point is less predictive than rainfall. An R-squared value of 0.43 suggests that it's not very accurate, but it does give you a very broad idea of whether stocks are expensive or cheap. And it's most informative when it's at extreme values, in other words, when it's very high or very low. Currently, the CAPE measure for the S&P 500 is over 30. And in the past, that's led to very low returns of close to zero over the following decade. And that's one of the reasons why I don't think there's a huge amount of upside for the S&P 500 from where we are now. This is what the purchasing managers indices looked like in 2018. The Eurozone, which is on the left, was coming off a fairly high peak, and the US was still trending upwards. In 2019, the PMI for Europe looks much less positive. It's been falling fairly strongly, but it remains above 50, which is the watershed for expansion versus contraction. Even the US PMI, which has been very strong while the rest of the world slowed down in terms of growth, has now started to tail off too. And that's painting a slightly less rosy picture looking ahead. And looking at the Chinese PMI, although it's not spectacular, as it was leading up to 2008 and 2009, it's still above 50 and doesn't seem to be falling. So I'm not particularly worried about a China slowdown. And that has positive implications for the whole of the Asia-Pacific region. If we look at US earnings growth, and that's the dark blue line, you can see that it got a big boost from the tax cuts that President Trump announced in the US. But the momentum from that boost is starting to tail off. And although stock markets did sell off at the end of 2018, they have bounced back since. But what's worrying is that earnings growth hasn't. It seems to have plateaued. And those of you who watched Wile E. Coyote cartoons when they were younger probably recognize this scenario. Earnings are leveling off, but equity prices are still rising in the US. So at some point there will be a reckoning. Either earnings have to rise to meet the value of prices, or prices will have to fall to meet the new lower level of earnings. Now previously I had a quite large allocation to the United Kingdom. That was a deliberate domestic bias, which is usually a bad idea. You can see 43% of my portfolio was allocated to the UK, and it was in sterling assets. The reason for that was my view about Brexit, which was that ultimately the government would come to its senses and produce a deal which was good for UK trade. In other words, we'd get a soft Brexit, and that would be positive for sterling. You can see that since the referendum, that sterling has been trading between 10% and 15% lower than it was pre-referendum. So if there had been a soft Brexit, sterling would have rallied, and the value of any foreign assets would have devalued very rapidly. And that's why I wanted to keep a domestic bias for my portfolio. However, as Brexit deliberations just drag on endlessly, it seems like no party has a viable way out of a hard Brexit. And in fact, some politicians are actually claiming that there's no such thing as a hard Brexit. And that's why I'm much less positive about sterling than I was. And that means I'm much more willing to take foreign currency exposure. And that means buying assets in foreign currencies in the US and globally. Looking at the returns since the end of 2016, you can see the Life Strategy 20, 40, 60, 80 and 100 portfolios are very close to this thing called the efficient frontier. That's the combination of Vanguard funds which would have given the best risk-adjusted return that was possible over this period. The fund which I chose last year to give me my global equity exposure was this Global Value Factor Fund. However, this time round, I'm going to go instead for a more cautious equity allocation in the form of the Global Minimum Volatility Factor Fund, which has a more cautious approach to equity. For my bond exposure, I'm going to have a combination of UK investment-grade corporate bonds, which give me a reasonable income that's slightly higher than I'd get with UK government bonds. And that's because of the increased credit risk that I take by buying this fund. And I'm also going for US dollar emerging market government bonds because they tend to give you a very high income. That was in my portfolio before, but I'm going to increase the weight. Now what's misleading about this graph is that the vertical scale is capital return. Not all of these funds are accumulation funds. That means that it excludes the effect of dividends. The annual income from the emerging market government bond fund is over 4%, so that would boost its return significantly. You can see that in this table where the Vanguard funds are sorted by their 12-month yield. That's the income that each fund would have generated divided by the price today, and that's expressed as a percentage. VEMT, which is the Emerging Market Government Bond ETF, has a generous yield of 4.7%. That's because I'm lending to emerging market governments, which have a very poor credit history. However, that Chinese PMI, which actually looks okay, fills me with some confidence that there isn't an imminent crisis in emerging markets. And China is actually the biggest exposure for the VEMT fund. Everybody wants to beat the market rather than just buy the market, and the way I choose to do that is to buy factor funds. Instead of putting my faith in fund managers to beat the index, I put my faith in peer-reviewed research in journals. And this research consistently shows that certain types of stock beat the stock market overall over the long term. Factors such as size, liquidity, value, momentum, volatility and quality have consistently beaten the market. Vanguard has industrialized these factors and made them available to us at a very low ongoing charge of just 0.22% per year. Vanguard Value is the fund I chose before. This takes three fundamental measures of value, combines them, and then buys stocks which are cheap. The momentum factor buys stocks which are rallying, because these rallies tend to persist. It does that by taking three measures of momentum over an 11-month period, 6-month period, and a risk-adjusted 1-year momentum, combines them, and then buys the stocks which rank most highly on this momentum measure. The liquidity factor combines three measures of liquidity and buys the stocks which are least liquid. These are usually small stocks which tend to trade less and which therefore command a risk premium, which you can harvest by buying this fund. And finally, there's the Global Minimum Volatility Factor Fund, and this is the one I'm going for this year. You'll notice it's got significantly fewer stocks than the other funds. There are under 200 stocks in a fund, but it scrupulously avoids having exposure to too much of some common risk factors, such as having too much money in one country, in one sector, in individual stocks, or in any of the other factors which we've seen, such as liquidity, value, growth and size. And it's also dollar hedged to reduce risk further. What I also like about this fund is that it has a fairly chunky allocation to real estate investment trusts, and the acronym for that is REIT, R-E-I-T. You can see that it's got 15.8% exposure to diversified REITs and 5.7% exposure to residential REITs. These provide a little bit of extra diversification away from equity, and they're also usually paying a relatively high income, which helps smooth out the ups and downs of the capital gains and losses that you typically see with equities. If we break down the allocation by country, this fund still has 50% US exposure, but there's really no way around that. The US market is so big for any asset class that you simply can't avoid this bias. So those are the things which have changed. what aspect of my allocation hasn't changed? People like my Scooby Doo metaphor for diversification. The idea is that if you wanted to explain Scooby Doo to someone, how would you do it? A simple list of the characters wouldn't be very informative. But if I tell you that Shaggy and Scooby are the clowns of the group who always get into a pickle and usually generate most of the interesting storylines, that Fred and Daphne are the slightly preppy leaders, and that Velma's the smart one who's usually the problem solver, that would give you a fairly good insight into how Mystery Incorporated holds together, and more importantly, how each of the individuals behaves. I can build the same kind of tree for funds, but it's a horizontal tree with the roots on the left and the branches on the right. When we build that tree for Vanguard selection of funds, it splits very cleanly into bonds on the top and shares on the bottom. I've characterized the bonds as being boring, like Velma, and the shares as being exciting and slightly crazy, like Scooby. Now this time round I just want 3 funds, so I've sliced the tree where there are 3 branches, and by choosing one fund from each branch, I ensure that my portfolio is diversified. In red, you can see the grouping of bonds which are denominated in sterling. In green, bonds which are denominated in dollars and euros. And in blue, the tight cluster of global equity funds. From the top branch, I've chosen VIUKGB, that's UK Investment Grade Corporate Bonds. From the non-sterling bond branches, I've chosen VEMT, the US Dollar Emerging Market Government Bond Fund. And for my Scooby Doo equity component, I've chosen VMVL, the Global Minimum Volatility Factor Fund, because the equity market still looks greedy, so I still want to be fearful. Now that I've chosen my 3 funds, I'm going to choose how much capital goes into each one. As a very rough guideline, I've run these 3 optimal portfolios. Minimum variance would have given me the lowest risk over the last 3 years. You can see it's put lots of money into VIUKGB, because that's a very low volatility fund. Maximum Sharp just goes for the highest risk-adjusted returns. That's avoided VEMT completely and put money into VIUKGB and VMVL in the ratio 60-40. Risk parity, which goes for equal risk contributions, also favours VIUKGB because of its low volatility and has VEMT and VMVL in roughly similar quantities. But the equity exposure there is too low. I want to boost it to around 40%. So rather than take the risk parity weightings, which are in blue, I've boosted the equity component with VMVL up to 40% and scaled VEMT and VIUKGB to be in the same ratio of roughly 2-1. So my final weights are 40% for VMVL, 40% for VIUKGB and 20% for VEMT. And that'll be my new allocation for 2019. So there it is, my 2019 allocation. I hope you find that useful, the process by which I came to the allocation. As I say, don't copy it. Just copy the process, or perhaps use it to come up with your own process by which you construct your portfolio. Now, if you want to support us, please do. You can join us on Patreon. Just click on the links above and you can just subscribe for $5 a month. Or if you go to the $15 a month level, then you can have a power hour. That's a one-to-one with me every other month. And I'd love to see you on those weekend calls if you join us. So as always, thank you for listening.